Hi, everyone. This is Jeff Praisman with Interactive Brokers Podcast. It's my pleasure to welcome back to the IBKR Podcast Studio, Mat Cashman, Principal and Instructor of the Industry Council and OCC. Hey, Matt, how are you?
I'm good, Jeff. Thank you. I also go by Mott, if you want to call me Mott.
Like Mott the Hoople?
Yes, exactly like Mott the Hoople, but not really.
Oh, it's always good to have you back in this nice, warm February day here on the East
Yes.
Coast. And today we're going to talk about something that was a pretty hot topic the last year, maybe a little bit more, but short duration options, also like zero DTEs or 0 days to expiration.
Yeah, for sure. I think it's been longer than a year, Jeff. I've been talking about this stuff for a long time now, and I wanted to talk about it a little bit, a slightly different way than we usually approach this conversation. A lot of this conversation about short dated options focuses on things like speed and leverage and gamma. And I've talked about that stuff on this podcast many times, right? And all of that matters. But what tends to get a little overlooked in this discussion is structure, is the behind the scenes part of how these actual products and these options are designed. And when expiration starts to compress and then become a regular cadence that happens in the market, structure really stops being a background thing and starts driving outcomes a little bit more. And we want to talk about that today.
This isn't really a how to trade zero DTEs. It's more about how they're constructed and what sort of how they differentiate, I guess, just by the pure amount of times that they're going to expire versus regular expirations.
Yeah, absolutely. We're not going to be talking about like how to trade zero DTE today. What I want to talk about is understanding what kind of option you're trading, because when time gets really short, and sometimes, especially now, we have products that are going to look similar on the surface just because of their duration, but they can behave very differently at expiration depending on some of those parts of the back of how these things are structured, and people need to understand the differences there.
Yeah, and just to take a step back for our listeners, obviously back in the day, equity options expired at expiration once a month. Then it moved to weeklies. And then obviously index options different. They moved to Wednesdays, I think, and Mondays and Fridays.
Yep.
Now they're every day basically. And then also though, ETF options, which are more equity options, American style, which I'll let you explain to the listeners in a second.
Yeah.
It started daily basically. And now as of, I think it was January 26th, the NASDAQ listed, I think about 9 or 10 equity options. So Matt, if you could kind of start with just like the basics, like quick sentence on American versus European, why it matters. And then also market closes at 4, but like that's not necessarily what that's going to factor into our conversation. I don't want to give too much away for the listeners.
No, of course. Yeah. There's a couple of, as people say on podcasts very often, there's a lot to unpack there, right, Jeff?
Right.
So the first one, I want to respond directly to what you asked for, which is essentially the difference between American and European style options. The biggest difference, and particularly the one we're going to talk about today, is that American style options have the ability to be exercised early before they fully expire, right? Like that's part of the way that American style options are designed, and it always has been. It's part of kind of just how they work. European style options can only be exercised at the moment of expiry. And so they expire and are exercised all at the same exact time. But American style options have the potential to be exercised early. So that's going to factor into our conversation pretty significantly as this goes on. But you also said something about the market closing at 4, and that is technically 4 p.m. Eastern. That is technically true. The stocks close around 4 p.m. Eastern. That part is true. But the life cycle of these options, especially American style options, don't necessarily end at 4 p.m. So I think that's something that I think we are going to talk about exclusively today.
Yeah, and that's a great point, because there is a difference between the close of the market and then when they'll be exercised. And for our listeners that may not know this, there is automatic exercise process.
Yes.
If your options are in the money, generally the system will generally handle it for you. And obviously, though, as the number of expirations increases, this can become more and more important for your trading strategy. You could maybe walk through, like, you can set and forget it and it gets exercised, but you can also send counter instructions to any of your brokers. And I think it's important to point out that, like, while there is a standardized time that the OCC needs to get either the exercise notice or the contra don't exercise this, there is a couple hands that have to touch it first, right, Matt? And that's sort
Yeah.
of why, and they can differ. So it's really important for listeners to check with their broker, what their specific cutoff time, because it can vary slightly. And that's something that you, as an educated trader, you need to know.
Yeah, absolutely. And that, I think, is a big part of this conversation, is that I'm trying to essentially advocate for people to understand as much of that as they possibly can. Because essentially, when you think about it, as an end user of the product, your actual agreement is with your trading or brokerage firm. And so that agreement is what's going to dictate, like, when you are and when you are not allowed to exercise or contra exercise those options. And so the first thing I want to touch on is the difference that you mentioned, which is the auto X process, right? That's something, and it stands for auto exercise. Obviously, we shorten it to auto X. But what that really means is that most of the time when options are in the money and they reach a certain threshold of being in the money, which usually is 0.01, 1 cent in the money, if the option is part of the auto X process, it will be automatically exercised if it's in the money and not exercised if it's out of the money. So that's to set the table as far as what this looks like from the OCC's perspective. That process covers a majority of options. If your option is one of those options that's not part of the auto X process, there is always an information memo that gets published and put on our website telling you that your option class is not part of auto X. And if that is the case, you always need to decide whether or not you are exercising or not exercising that option. But those are usually edge case scenarios. That happens often in things like corporate actions, or when the stock is halted and the options aren't trading, something like that. And so if that is happening, you should definitely reach out to your brokerage firm and find out what's going on there, and take a look at the information memos on the OCC's website, because there'll be one if your options are out of auto X. But most of the time, the assumption of auto X holds true. Where things get interesting, right, is around this thing that we mentioned, the contra exercise window. And that's the period after the close when an investor can provide instructions that differ from what the auto X process would normally do. And that's what we want to talk about today.
Right. And that can go both ways, right? So, like, if I'm short the option, I don't have any control over it.
Yep.
And and if, say, it's a 50 call and stock is going between 49.98 and 50.05,
Yep.
I may not really know whether all of a sudden I'm going to be short stock or not come the next day.
Yep.
And vice versa. Like, if I'm long something and I am, whatever other my positions may vary, it may be advantageous for me to exercise it or not exercise it. And I sort of have to make that decision too, if it keeps kind of bouncing around. And I think what we're going to get in today is obviously that risk increases when you're going from indices, or I should say ETF options in this particular case, to now these individual equity options that are listed, and for several reasons, which I know you'll get into.
Yeah, absolutely. And the real crux of this is the difference between what I mentioned before, an American style option and a European style option, right? That's really what we want to drive home here. And this is the part I think that people often miss. And what you just said is very true. Contra exercise, right? That window can cut both ways. It can be that you're opting out of an automatic exercise of an option that is in the money. If an option's in the money and it finishes in the money at 4 o'clock Eastern time, you still have time to actually give what we call contra exercise advice through your brokerage firm and then through the clearing member firm to OCC to make sure that you don't exercise that option if you so desire, if it's an American style option. But it can also mean that you want to affirmatively exercise an option that technically finished out of the money, right? Like if you had an upside call, and in that situation you were talking about stocks trading 49.95 and you own the 50 call, and then after the close the stock goes to $53, right? You are economically, like, it's a good idea for you to exercise that option in that specific case. And so in those situations, you can also, when those economic situations change after hours, you can actually do that with an American style option, but you can't do that with a European style option. And so that's part of the reason why we're talking about it.
Yeah, and to be clear, there's just nothing new as far as zero DTs versus weeklies versus
Right.
monthlies. It's just really more the cadence, right? It's just a more frequent risk.
Yes, absolutely. And I talk about this a lot as previously when I've talked about zero DTE options more broadly.
Mhm.
This is like options have always had some sort of zero DTE quality to them. We just didn't have a name for it like we do now. Options have always expired on their expiration day. What's
Right.
different now is the cadence of expiry. And so instead of having one major expiration event every month, which used to be the third Friday of every month. You touched on this at the beginning of our conversation, right? It kind of the cadence changed. Then it went to Monday, Wednesday, Friday in certain places, and then it went to Monday, Tuesday, Wednesday, Thursday, Friday, and then Monday. And so now what we have is a situation where you're in many places you're seeing expiries every day. And so the operational edge cases that used to show up occasionally, like what I was
Right.
saying, on the third Friday now are kind of a regular part of the regular rhythm of the market. And so I think it's important we start to talk about that.
Right. So it's really, again, like I said, it's not new. It's just more frequent.
Yes.
And people hear zero DTs and they assume that the risk is basically the same, whether it's an index or an ETF or a single stock. But that's we kind of touched on earlier. Like that's really not the case at all. And
Yes.
like, and especially now with these single stocks, like what are some risks that these single stock zero DTs have that definitely the indices didn't really have it, and even the ETFs are much more muted.
Absolutely. I think that's really a core part of this discussion. And that's where it's worth being very explicit in this discussion. When you're talking about something that's a single stock, it
Mhm.
has those kinds of idiosyncratic events, right? They have things that affect the stock specifically that wouldn't necessarily affect the broader index. Now, we're in an environment where more of those broader indexes are made up of these core everyone's talked about the magnificent seven over and over again, and so it's becoming more a part of the index. You're still dealing with something when you're trading index options, that you're trading something that is more diversified than just an option on an individual name, right? We could have things like corporate events that happen
Right.
that only really affect this one stock and affect it in a very, and sometimes in a kind of like a binary way. And so that's really where those edge cases have more risk built into them when you're talking about individual name zero DTE options. It's important to understand that. And because of the fact that those options are American style options, like I said, you have that early exercise potential where
Mhm.
someone holds the ability to be able to exercise or not exercise that option within that specific window. And that's going to make a big difference, right? Earnings announcements, guidance changes, merger news, regulatory headlines,
Right.
think about all those things, right? And they're idiosyncratic to the name itself.
Right. And with those single listed zero DTEs, those risks aren't able to really diversify away like an ETF or an
Exactly.
index.
Yeah. That and the when you're dealing with index options, the diversification of the index kind of absorbs some of that, those idiosyncratic things, right? Because it's a
Mhm.
broader based thing. But in this case, if you're dealing with a single stock name, it doesn't do that. And so that's really important to understand. It's the whole outcome of that option, especially within that window.
And why does that matter more though for the zero DTEs? Like if I own an Apple call that's going to expire on Friday, like it's still going to see those moves if it has those headlines on Tuesday or whatever, whenever
Yeah.
they come out with earnings.
Yeah, absolutely. The reason it matters is because there's no time buffer left, right? It's not a 90-day option where you have 89 more iterations of
Mhm.
price movement in order to decide whether or not you want to exercise the option. It's right now, it's a 0 day to expiration situation. And in something that's like an after hours earnings move, you're not reassessing it necessarily tomorrow. It's immediately relevant to what that option is worth and like how much you can make or lose depending on whether you exercise or don't exercise. And so that's really why it matters with these because the time duration is shortened.
Right. So you don't get a second or a third or a fourth or a fifth trading session to get to see what happens with the underlying.
Exactly. Yeah. In longer dated options, right? The overnight move is something that you can digest and think about and
Mhm.
be like, oh, does this change my my overall look as to what my time horizon is or whatever. In this case, right, the 0 DTE spot, it is the expiration. It's the event. And so it's important to understand that.
So where do ETFs fit in this?
ETFs kind of sit somewhere in the middle, right? They're diversified, but they still trade like equities. And technically they are equities. They still have after hours movement. They still hold underlying components that can be affected by sector specific news. And so they're the gray area, I would say, that's in the middle.
And what about index options? I think a lot of people might confuse ETFs and indexes sometimes, right? Like they'll see SPY and confuse it for SPX, but they are very different, right?
Yeah, absolutely. Index options, like I said, for the most part, are predominantly European style cash settled options. And so that essentially, for lack of a better term, it strips a lot of this away as far as additional risks. There's no early exercise, which also means there's no contra exercise window. There's no delivery of the physical underlying, because in many cases, you're talking about an option that's trading on an index that actually doesn't have a physical underlying, right? It's that the underlying is this thing that's made up of all the prices of the individual components of it. And so the settlement of that whole situation is very formulaic. And I think it also, you need to think about the fact that many times people have adopted those options in that way over time because of that reason, because of the fact that they don't have to deal with the early exercise idea or the risks that are commensurate with that, dealing with the individual stock options. That's part of the reason why people have, if you ask institutional investors why they trade like index options, part of the reason is they want the diversification. But the other part of it is like, I want to trade something that's a European style option so I don't have to worry about whether or not it's getting exercised early, right? And that's a part of the way that risk is set up for those options.
So a lot fewer paths where something unexpected could show up, especially later, like late by
Yeah,
expiration.
absolutely. And that, right, that doesn't make sense. That doesn't make index 0 DTE options low risk. It just means that the expiration mechanics of it are clear. They still have lots of other risks that are associated with it, but the endpoint, right, that time at 4 p.m. Eastern time is different for that option than it is for an American style option.
Right, which matters more, especially the shorter. It matters more the shorter the duration gets.
Yes, absolutely. And I also think that's one of the reasons why those 0 DTE option products scaled so quickly in the European style options, because the finish line is just simpler. Just like I just said, right? Those institutional investors that choose those options for that reason, right? That kind of thinking about those options has been really prevalent in the adoption of those options also along the way that we've seen.
So Matt, what do you think people are what do they misunderstand the most with these 0 DTs?
Well, right now, I think, and we haven't seen this yet, right? We're super early in the listing of these Mondays and Wednesdays on single stock names that are American style options. And so I don't want to like sound any alarm bells or anything. That's not what I'm trying to do here. What I'm trying to pinpoint for people is that I think one of the risks that might be on the horizon is that people are assuming that the mechanics of these are standardized because the symbols and the duration looks standardized. But the variability isn't in the options contract, it's in how the expiration process is handled, like in an operational way. And so that part is a little bit more opaque. It's a little harder to understand. You have to go and dig kind of one level back and see like, okay, what are the contract specs of this? Is this an American style option or a European style option? And then you have to think about that time window and the auto X process and all of those things when you're dealing with American style options. But from the outside, especially if you're just looking at it from a duration perspective, you might think like, oh, this is just a 0 DT option, just like anything else, and not do that digging. What I'm encouraging people to do is do the digging to figure that out, because that's where this matters.
Right. And you don't want people to assume something and all of a sudden the opposite happens and they're like, wait a second, I thought this was gonna happen, and that happens instead.
Yes. And we get email questions about that already on our investor education desk. And that's just in, right, like options that are individual stocks that have come to expiration and it's on Fridays or whatever. And so now, right, the way I look at it, and I have to look at this and think like, okay, like how many more people are going to be emailing us with situations like that, asking for an explanation as how this happens. And the answer is most likely there's going to be a lot more people talking about it and asking questions and things of that nature. So part of my job as an educator is to get ahead of that and say like, listen, think about what this is, right? Think about whether or not this option looks comfortably in the money or out of the money, and whether or not it's American or European style before you start just like doing the set it and forget it vibe, right?
Yeah, and Matt, this has been great as always. Love having you come in, talk about options. Is there any final thoughts you want to leave our listeners with? I think you really covered a lot with the zero DTEs, especially the new kind of additional risk added on for individual equities. Again, we don't want to discourage anyone from doing trading or anything. We just want to make sure that everyone's educated on potential risks and knowing what they're getting into before they get into it, basically.
Yes, absolutely. I mean, I think that's really the crux of the whole thing. It's not my job as an educator is not to tell people not to trade short dated options. Obviously, my job is to make sure that people understand what they're trading before they trade it, or like when they're trading it, and help them to understand what that means. It's not don't trade short dated options. It's know what can move the stock and know particularly when your decision making window ends. Because in this case, it can be different from brokerage to brokerage and trading firm to trading firm. And so make sure you understand what that cutoff time is. It's a big deal. And right now, when we're dealing with the transition into having zero DT options that are moving into American style single names, it's going to be something that's going to show up on people's radar because of the cadence of these expirations, right? We used to deal with it every third Friday, and now we're going to be dealing with it every like Monday and Wednesday in certain names and things of that nature. And you can expect them to, like when these things get listed, they generally expand as far as like people like to use them. And I want people to use them for the intended purposes, but I want them to understand the limitations and the contract specs of what they're trading.
Matt, thanks again for stopping by the studio. For our listeners, to get more from Matt, you can go to occ.com. You can go to IBKR.com, click on education. You can see all our past webinars and podcasts that we do. And again, thanks for stopping by.
Absolutely. Thanks for having me. If you want more information about options education from the OIC, you can also go to optionseducation.org.
Excellent.
Thanks, Jeff.
Yep. Thank you.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Options involve risk and are not suitable for all investors. For information on the uses and risks of options, you can obtain a copy of the Options Clearing Corporation Risk Disclosure document titled Characteristics and Risks of Standardized Options by going to the following link: ibkr.com/OCC. Multiple leg strategies, including spreads, will incur multiple transaction costs. Any discussion or mention of an ETF is not to be construed as recommendation, promotion, or solicitation. All investors should review and consider associated investment risks, charges, and expenses of the investment company or fund prior to investing. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice.